Hello friends, welcome to the world of financial management. Today we will extend our studies of capitalization. In this particular session, we will be learning the cost of capital and several specific cost of capitals. So friends, there are two ways by which cost of capital can be defined. Approach number one, cost of capital is the minimum amount of expectations that every investor would expect from the amount which has got raised through him for the capital formation. In short, it is the minimum rate of return which one expects from its investment. Another approach to look at cost of capital is cost of raising funds. So cost of capital is nothing but the rate at which you have raised the capital or the minimum rate of expectations that every capital source would be expecting. When it comes to the several types of cost of capital, they are specific cost of capital, weighted average cost of capital, historic cost of capital, and future cost of capital. So friends, first of all, let's look at the specific cost of capital. As I said to you, capital has two different sources, equity sources and borrowed sources. In equity, there is equity shares, preference shares, reserves and surplus. In debt sources, there are debentures, bonds and loans. And hence, all these six sources becomes the six different specific cost of capitals. So, the first one is cost of debt. So, cost of debt is nothing but the minimum rate at which every debt supplier would be expecting from the investment that he has made in the process of capital formation. Or, cost of debt is cost of raising the debt funds. So when it comes to the formula of calculations, the cost of debt known as KD, and the formula is I in bracket 1 minus T plus F minus P divided by N divided by P plus F by 2. In short, I is interest, T is the tenure in years, F is the face value of the amount of debt, P is the net amount realized, and N is the number of years. So this is the formula through which cost of debt can be calculated. Moving further, cost of term loan. Cost of term loan is the minimum rate of return which the term loan is going to expect, or cost of term loan is cost of raising the term loans. The formula is very simple. Cost of term loan KD or KL is equal to I in bracket 1 minus T. Taking it to the next, cost of preference capital. Cost of preference capital is the minimum rate of return which every preference shareholder will be expecting from the investment, or cost of preference capital is cost of raising the preference share capitals in the capital formation. The formula to calculate the same is KP is equal to PD plus F minus P by N total divided by P plus F by 2, where PD is the preference dividend, F is the face value, P is the net amount realized, and this is the formula for KP. Taking it to the next, cost of equity. Cost of equity is nothing but it is the minimum rate of return which every equity shareholder is going to expect, or cost of equity is cost of raising equity shares. There are three approaches by which cost of equity can be calculated. Number one is dividend price approach. According to dividend price approach, cost of equity KE is equal to D by P, where D is dividend per share and P is market price per share. According to dividend price per growth approach, the formula for KE is D by P plus G, where D is dividend per share, P is market price share, and G is nothing but the growth rate of an economy. There is one more method by which cost of equity can be calculated, which is earnings price approach. According to earning price approach, the formula for cost of equity is EPS divided by P, where EPS is earnings per share and P is nothing but market price per share. So these are the three methods by which you can calculate cost of equity. So friends, here we have attempted to understand the specific cost of capital which are being used in the process of making the formation of capital, and they also gives you the essence of the amount that arises as a liability through a particular source of capital which you are attempting for raising the capitals. I hope you enjoyed the video. Keep watching the same and keep an eye upon my next video on capitalization. Thank you.